Time to catch up with our guest of the hour, Jan Friedrich, Senior Economist at the EIU. Hello, sir. Wie geht's? Guten Tag. You folks at the EIU have actually gone a little bit more optimistic on the global economy. So kind of polarized. Here you go, a little happier. Rubini says, nope, we'll look out for another crash.
Well, it's a bit more nuanced. We've become more optimistic about this year and 2010, but we've become more pessimistic about 2011. Basically, the story is that we now believe that the stimulus package in the United States and in quite a number of other countries is having a massive impact. But we are more and more concerned about the situation that occurs when these stimulus fades. And in the United States, that will be 2011. In 2009, 2010, the U.S. is spending something like 2% of GDP on fiscal stimulus. It can't continue to do so for the foreseeable future, so it'll have to stop at some stage, particularly given the size of the budget deficit.
What's the drag going to be then? It's going to be a very, very untenable kind of a deficit situation that they're going to have on their hands in 2011?
Well, the deficit has already risen, or has already risen to something well above 10% of GDP. It's totally unprecedented. And so clearly corrective action on the deficit front is necessary. And even if that wasn't the case, appetite in Congress to renew the fiscal stimulus definitely is not there, at least not at present, and probably will not come back over the next 2 years. So the big question then is, well, is the current stimulus leading to sufficient private demand that no further stimulus is necessary in 2011. And the big disequilibriums in the economy mean that is relatively unlikely.
The idea behind the stimulus is to kind of front-load demand and kind of entice people to get out there and keep the money multiplying effect going. At some point, you're supposed to let loose, cut loose, and hopefully it'll keep self-generating or perpetuating. Is there any evidence that is happening, or is it all artificial still?
I think very, very large. It's impossible to tell because the stimulus goes through the economy, and if you see private consumption, for example, improving slightly, that doesn't, and even if it's not directly linked to government programs, that doesn't mean that it's entirely privately driven, autonomously privately driven. So I think a very large share of the improvement now is stimulus driven, and the very, very large decline in household wealth, something like 160% of disposable income over the last 2 years. Of 160% of disposable income, annual disposable income, really requires a rebuilding of balance sheets and therefore consumer restraint, and that's poison for the economy.
Okay, so net, the chance of, you sort of do see a Rubini-like scenario developing, another sort of a double dip or a waning in the momentum.
We don't say a recession in 2011, but we see a renewed weakening.
Yeah, I know what you mean about it's hard to tell whether the stimulus is having just a synthetic or a real follow-through effect. After all, they don't do exit polls at Walmart and ask people, why did you buy those pickles? Because Obama said you should, or because you really want them?